Well, good evening and welcome everybody to the Financial Freedom Classroom. Before we get going, there's a couple things we need to go over. I'd like to remind you that we are not financial advisors, accountants, lawyers, tax preparers, and therefore any information on this presentation is no substitute for professional legal, financial, accounting, or tax advice. Also, the information provided is for general information only. It's been prepared without taking into account your objectives, financial situation, or needs, so make sure you consult a professional prior to taking any action on there. The Financial Freedom Classroom is consisted of Sherry Locke and myself. We're owners of Locke and Your Success LLC, which is a stock options coaching and education company. We've managed many successful businesses in the past in the automotive, real estate, computer consulting, coaching, and martial arts industries. We're also active real estate investors. We do spec home building, and so we've done some rehabs, and we occasionally provide loans and guidance to small businesses. So today we're here to talk about taxes, the good, the bad, and the ugly with Kim Landry, a CPA. And here's Kim. Kim here. She and our family have been very good friends with ours for, oh gosh, I don't know, for a long time. And she's not just kind of your average accountant. She's very proactive and gives lots of great advice and really digs in there and makes sure she saves as much possible, much information as possible. She's just really, really good at giving really bad news. If you make a lot of money, unfortunately, the law requires you actually have to pay it quite a bit, but if you want to do the best possible, you have to get a good accountant on your side. So we're very fortunate and thankful that we've known her, and that she's actually will do our financial stuff for us, and we're very thankful also that she's here. Hello, Kim.
Hi, John. Thank you very much. Thanks for those kind words.
Oh, you're welcome. Now, did you want me to switch switch over to your screen?
Nope. We're good. We can stay right with your screen, and we'll just kind of hit the points as necessary. And if your listeners have any questions, they can type them in, and I'd be happy to try to address those concerns.
That's fantastic. Yeah, and the first question is, are you still taking new clients?
Yes, I am. Yes, we are. Time is ticking, so new clients that do come in may need to file an extension, but we are definitely able to serve them.
That's fantastic. I know, Kim's, I don't know, how long have you been, you've been doing taxes like forever, but recently her office has expanded quite a bit, so she's been been able to take on a lot of new clients, and partially because the word gets around, and you just have people knocking down your door when that happens, don't you?
Yes, yeah, and it's been good. We've built our staff up, and we have 2 other CPAs on staff, both with specialties. One, an ex-IRS agent, so that's always great to have in our back pocket, and can help clients with any issues that they may have with the IRS.
Wow, that's fantastic. Now, we were talking about some well, this is the good. We get the good slide up here. What's a good thing that we have with businesses and stuff like that? Because it's a big difference from someone who's an employee to someone who starts their own business, right?
Correct. And really, owning your own business, I believe, is one of the last good write-offs and deductions that you can have. The standard person who works at a company receives a W-2, things are pretty cut and dry. Your deductions are limited to what the government tells you that you can deduct, and there are very few options that you can do to really save some tax money. As a business owner, you have the ability to deduct any expenses that are ordinary and necessary. Able to take advantage of a home office deduction if you haven't, meet the requirements and work from home. Those expenses would normally not be deductible. So with a business, that really is a great advantage.
Yeah. That is a huge advantage. I know a lot of people who watch these are actually they're traders, and Do traders have, what's the tax situation like for them?
Traders, there's many options. You can set your business up in different forms, and most traders do work from home. So as long as you have that dedicated office space, you're allowed to deduct a portion of your utilities, your heating, insurance, taxes, and insurance right off of your business income, which would save you that self-employment tax in addition to your federal income tax bracket rate.
Right. Now, do they have to do something special to be able to be called a business if they're a trader?
If you're actively engaged in trading and you're doing it to make money and not looking for the long-term hold all the time, and it's not a hobby, then you could get classified as a business.
Okay. Does that mean you have to actually qualify for trader status or something like that, or is that just...
If you have that trader status, that does help some, but you can definitely, you want to have that trader mentality. Where are you generating your income? How are you living? If you have a full-time job and you're trading on the side, it's depending on, the volume and what you're doing will dictate. So each individual, it's going to be really specific to them as to when it really becomes a business for them.
Okay, that's really interesting. I know.
But even if they're just investors, there are some things that they can take as miscellaneous itemized deductions, journals, research, charting tools, and those type of things as investment expenses.
Okay, yeah, that's cool. And I suppose I could always do kind of like what I've been doing too. Is I kind of have this coaching business going on, and we can take deductions off of that, and kind of leave our trading alone because
Correct.
Yeah, so that's kind of cool if you have that. But I think it's definitely worth having a business because, boy, I mean, no matter what it is, right? Because you can just come in here and you can just, maybe deduct. Of course, they have to be legitimate, but you can.
Correct. And it's just really, it's a good option to, when you do have your own business, no matter what kind of business it is, it allows you to take some of the everyday expenses that you have, whether it be a portion of your cell phone or the home office and utilities and cable and not cable but internet access and things, and make those deductible. You have the option of employing your children in a business and being able to take advantage of their lower income tax bracket if they actually provide a service for your company. So there are a lot of great options with the business.
Right, like I have my girls. They come in here and they'll edit my emails and look at some of my presentations and stuff like that, and I can pay them, and money stays in the family, so that's a good thing.
Correct. Correct. And what's really nice about that is the girls can start investing into a Roth IRA with that money. So they can start planning their retirement. And if you start those investing habits early, by the time they're old enough, they have a nice little nest egg built up. And if the tax laws stay consistent, a Roth, they'll not pay any tax on any of the earnings on it.
Yeah, that's one of the things that surprised me. Sherry told me, she said, well, you pay taxes, you put money in this Roth IRA, and you can make money within it, and then when you take it out, you don't have to pay taxes on it. I said, no, that's not right. They'd never allow that.
Yes, I know. There's a few rules in it. You have to own the account for 5 years, and if you are above that 59 and a half and start pulling money out, there's no income tax on it. It's a beautiful thing. They haven't changed the rules on it yet, and it really has helped a lot of people, especially the younger generation, when you have, a good amount of time for that wealth to be accumulating.
Right, right. I mean, it's kind of a no-brainer because, I mean, you have to figure that in, I don't know, 30 years or whenever you're going to take it out, taxes are probably going to be higher than they are today.
Yep.
Plus, you don't have any tax on those gains. And, I mean, if I have a regular IRA and I have $1 million in it, I really only have like $600,000. I don't know, whatever the number is, right? Because
Right.
the rest of that money belongs to somebody else.
hmm And it's a great way, each tool has its place in your tool bag. I kind of look at everything that you have options to as being, just another tool. You can manage your tax bracket and your adjusted gross income by having a traditional IRA, having a Roth IRA, having some cash value or investments potentially into life insurance. And still be able to have income coming into the household to pay your living expenses, but not all of that income has to be taxable.
Wow, yeah, that's pretty exciting. So it's definitely worth probably talking to somebody who knows what they're doing so that you can arrange stuff like that. Yeah,
exactly. And timing of investments and selling and taking advantage of your capital gains rates and all of that. There's a lot to it. It's not just a compliance. If somebody's really just going to get their taxes done to, say, okay, I've got them done, and then just puts them in a drawer and never looks at them, I don't think they're probably being served well. You really need to be looking at those taxes and planning out what you're doing for the next year so you can really minimize that tax burden and, again, try to keep that as much money as possible into that family unit.
Yeah. Keeping all your money is extremely important. It's you have to make twice as much to have the same thing. It's no good.
Yep, that's for sure.
Right. So let's see. What else do we have going on here? I mean, well, you know what else Sherry was telling me too? If you have money in a regular IRA, sometimes you can transfer it over into a Roth IRA without having to pay taxes under certain circumstances, even maybe. I don't know.
Right, exactly. There's a provision that you can take a traditional IRA and roll that into a Roth IRA, and if you're within certain income limits, you don't have to pay any tax, or the tax could be at a lower rate. So let me give you a great example that I've had success with working with many of our active military folks. They're off on combat duty. While they're at combat, their wages are not taxable. So I had one couple where he was off deployed to Afghanistan. The wife is a stay-at-home mom. That year, they weren't going to have any other income that showed up as taxable on their return. So I said, hey, why don't we take some of that, IRA and that you have sitting there, use your item, because they still are supporting their household. They still have their itemized deductions. They have their kids. And we were able to tax-free change that traditional IRA into a Roth IRA, and now that when they go to take money out, no tax ever being paid on that money.
Wow.
So that's really cool. And so other situations to look for, if you have a large ordinary loss, maybe your business, you bought a lot of equipment and you have a loss because of depreciation, that's a great opportunity. You expect to be in, one of the lower tax brackets. If you're in the 15% bracket and you're normally in the, 25 or 33% bracket, that might be an ideal time to convert some of that traditional IRA into a Roth.
Yeah, that's fantastic. Let's see. We have a question here. I'm trying to read it here. It just says, am I correct that you don't have to wait till age 59 to pull any money out of any money you contributed, correct?
Correct. In a Roth IRA, you can pull out your contributions without penalty before that age 59 and a half. If you take any of the earnings prior to age 59 and a half, the standard 10% penalty will apply for early withdrawals.
Right, so there's really no drawback to actually going in and putting that in there, because you can, I mean, you put in as much as you possibly can by law, and then if you need that money later, you can pretty much pull it out. You just can't pull out your, well, unless you want to get taxed, you can't pull out your gains.
Correct. And again, you know, there are some limitations. You have to have owned the account for more than 5 years before you start pulling any funds out.
Yeah, that's pretty cool, though, because you put in a regular IRA, you're kind of like, you're not pulling money out of there.
Right, exactly. And again, going back to having, you know, kids starting a Roth IRA as soon as they have earned income, that starts that clock ticking on that 5 years of ownership as well.
Right, they put in like, what, $5,500 a year or something, right?
Correct.
And,
yep.
and I think we can pay them $5,000 out of our account, right?
Wow.
Yeah, very easily.
If they're working for us.
Mm-hmm. Yep.
So, as I think it's about up to 10, right, Kim?
For
Kids.
sorry?
The
Yep,
kids.
you know, it's based on, you know, each year it changes a little bit. They're allowed their personal, not their personal exemption because they're being claimed as dependents, but they do have their standard deduction, and for 2015, a single person can earn up to $6,300 of earned income without paying any tax.
Right.
That's awesome.
Right. So if my kids are working for me, I pay them, I don't know, $10,000 between the two of them, and
Yep.
I don't have to pay taxes on that money because I put it towards employees. They probably don't have to pay taxes because they didn't make much, and then they put it in an IRA,
Right.
and then a Roth, and then they can, you know, then that money builds if we trade with it or something.
Correct.
That's a awesome
Correct.
thing.
Yeah, because you can use the self-directed IRAs, and you can trade those, and you know, it's really kind of a neat little thing. And you're taking that money, and depending on how your business is structured, if they're under 18 working for a parent, there is no Social Security or Medicare taxes that are required to be withheld on those kids. So they're really getting that full $10,000, and it's moving from a higher tax bracket into a zero tax bracket. So it's a great win-win.
Yeah, that's really cool. Oh, go ahead, Sherry.
Oh, I was just going to, the technical, sorry, I just got on because my headphone wasn't working. So, but what I was going to say was that's a great way for the kids to have a trading fund and learn how to trade with that and have it grow tax-free? Mm-hmm. I can't believe it. That's such a good thing.
Yes.
Thanks for that.
Yeah, it is. It is, and it's good, and there's a lot of lessons to really get our children into being confident with their money and learning the value of earning the money and what to do with it, and that investing, getting those habits done early instead of just going out and blowing it.
Right.
So it's good all the way around, I think.
Good. So get some kids, get a business, pay the kids, and put it in a Roth.
Right, exactly.
So we do have a couple questions. I think this is a really good. Andrew said that this is a really good point. Is that you can keep your emergency fund essentially in your Roth investment. I would say the only thing to that is, like Kim had said, it has to be in there for 5 years, right? So you can make it grow so that it could eventually be that.
Yep.
But you really want that thing to grow too, because it's obviously tax-free. So.
Right, and that you've got that compounding effect of it doubling, every 7 years or whatever it is there. So to keep it all intact is really good. But it is a good option to put that there for emergencies, as long as you need to have some liquid.
Right.
However, having a fund there that's earning a little bit more than 0.1 at the bank is a good option,
And we have another quick question. Can you start a Roth for your kids after January 1st for last year?
Yes. You have up until the filing date, April 15th, in order to fund the IRAs for 2014.
That's great. I'm looking forward to it.
And that's the same with the traditional IRA as well. You have up until April 15th, the filing deadline, to make contributions for 2014.
Nice.
It's not too late to still take care of that. And while we're talking about those contribution limits as well, sometimes there are, if you're over a certain income limit, you're not allowed to make a contribution to a Roth. I have a great little tidbit that I use quite often is I will have somebody put that money into a traditional IRA for last year and then turn around and do that conversion to a Roth, and there's no gain built up yet inside of that 401, that IRA. So again, no taxes being paid, and you have kind of gone the backdoor route into making a Roth contribution where you could not directly do it.
Yeah, I was in that situation, right?
Yeah.
Sherry told me all about this Roth stuff, and she said, "Oh, but we make too much money." I was like, "What?"
Yeah, exactly. So there's that little backdoor way of doing it, and it's an extra step and an extra form to file, but in the long run, it's well worth it.
Yeah, definitely. Yeah, that's awesome stuff there.
Mm-hmm.
Did you have something, Sherry?
Nope. I'm just. I think is this slide? This is just retirement contributions. Sorry, I'm.
Yeah, we were kind of not paying attention to the slides, so I just went to the next one.
Yeah, we've just been kind of chatting away, and again, there are other options for retirement contributions, especially when you own a business. You can set up, solo 401ks. There's simple IRA plans. There's SEP plans, and you can really stash away quite a bit of money in those different plans.
Right.
So there are more options other than being stuck with, that $5,500 IRA contribution.
Right, because the $5,500 Roth contribution isn't going to help you with taxes this year. It's just going to help you in the long run.
Right.
If you want help this year, you have to go into something else, right?
Correct. I mean, you can make simple IRA contributions. They're $12,500 for 2015, and if you're over 50, you can put another $3,000 into one of them, get a tax deduction that way. There's other, 401k plans. Again, we're looking, $18,000 that we could, as a base contribution limits. And some other defined contributions that you can put up to like $53,000 in. So
oh, wow.
You're going to be able to, really stash some money in, and you're going to you're going to get the tax savings today, and you will have to pay tax on that when you pull it out in the future. But again, if they each have their own piece, in the toolbox. So
right.
They're all good. They all have a purpose, and as long as you're using, I'm a variety type person, having a little bit of different things.
Well, yeah, I mean, it's good to get your regular income down as much as you can on paper so that you can, have the tax savings. But, then, of course, it's really, really good to have some sort of a Roth so you can accumulate stuff tax-free. So I
Correct.
see both sides of that.
Yep. Yeah, definitely, and the Roths are good, but again, you're limited to those, $5,500 contributions. So, if you're starting a little bit later in life, you need to have a few more tools.
Right. Yeah. No. Definitely. For sure. Okay. Great. Let's see. Oh wow. We've gone through 25 minutes already.
Oh wow.
but that's okay. Do you have something really important for people to know in general as far as accounting and taxes?
This year, there's probably the biggest changes since the Tax Reform Act of 1986, with a lot of the Affordable Health Care Act being implemented this year. Some of it started last year with the additional Medicare tax and the net investment income tax. You know, that bill contains a real lot more than just health care. So really be on the lookout, and it's very important to have some great advice. People are definitely, if they've purchased their health insurance from the marketplace, have taken any of the advanced premium credits or are subject to any of the responsibility penalties, they really are going to probably need to expect some additional tax preparation fees. The IRS has issued, I think, 5 new forms for that this year. So,
John, you can scroll right down to the ugly because that's where that is. So,
Oh, well, let's go to the ugly.
yeah, we'll just go right to the ugly. And,
there it is.
I mean, I'll go on a great, one of the good things that did happen is President Obama did sign the extender bill. The bad news is it's there for 2014, and everything he extended expired on December 31st of 2014, so we're back in the same boat for 2015, where we're a lot of the great deductions are gone again.
Oh, so we lost a lot of deductions in 2014? Is that with the Affordable Care Act? Is that what happened?
Well, yeah, well, some of the stimulus provisions that were put into place expired at the end of 2013.
Oh,
and then
okay.
at the end of 2014, the Congress and the President signed into law reinstating those for 1 more year. However, they are now expired as we speak, and we'll see what happens during 2015 as to whether some of them come back or if they come back in a different form.
Now, what did they mainly do away with?
One of the biggest ones is the 50% bonus depreciation and the expensing of capital equipment that businesses, when they purchase, they can take a year, a big chunk of it all in 1 year.
Right.
And, you know, that was gone from $500,000 back down to $25,000 in 1 year. So that has really some big companies and even some small businesses that I work with. It's really put a damper on their tax situation.
Oh, that's too bad.
Yeah, you can afford a lot more if you can deduct it off. Yeah, even small businesses, they may have to make $50,000 investments, $100,000 investments sometimes. Yeah. Wow.
Yeah. Yep. So that was one. Those are the big ones. And education, the tuition and fees deduction, that's gone. Teachers, they lose the ability to take $250 worth of supplies off of page 1 of their tax return. So.
Right, yeah.
A lot of good things. Yep.
Wow, yeah, because a lot of teachers, they do. They come in and teach. Some of them are really good. They come in, they buy their own supplies for their kids because the school won't buy them. And boy,
yep.
they'd be able to write some of that off. That would be good.
Correct. Yep. Yeah, and they don't have to itemize. So you're looking at the young teacher that maybe just graduated college, they can invest in some of those items and still get a deduction without having to own a home and itemize on their taxes.
Wow, or at least they used to be able to do that, right?
Yes, that's right, yes. Not in 15.
That's too bad.
Yeah.
So, John, if you scroll up, maybe there's a little bit of, we should probably go over a little bit of we went over a lot of the good. But let's see. Oh, yeah, let's stay there for a second. So 1031 exchange, Kim.
Oh, yes, I love that for investors. That's one of my favorite things is delaying a gain is almost as good as, tax-free. It's a second best thing. A great example, I have a client that I've worked with that had a building that he owned in Massachusetts, bought it in late 70s, and wanted to move and, get out of that building. However, if he were to sell it outright, he would owe quite a bit in capital gains, and all of his other income would be pushed up to the highest tax bracket. So what he decided, we put a plan together that he was going to purchase another building. He wanted to move south, so he bought a storage unit facility down in Georgia, and that's where he rolled that gain, never paid a dime of tax, and our end game is that he will pass away with this property, and it will pass to his children, hopefully under, with some trust and some other planning, under that $5 million estate tax, and the kids will get a step-up in basis in it. So,
see what I mean about how Kim is really good at giving you bad news? The good news is you don't have to pay taxes. The bad news is, well, you're going to die.
Yeah, you're going to die. Yeah. Yeah.
Oh my gosh. So Kim, let me ask this. So the kids. So So this is obviously it's kind of his life plan. That's what's going to happen. So when the kids get it, now I understand in a Roth. Okay, so correct me if I'm wrong, but I heard that a Roth you can transfer to your heirs or whoever you choose to do it, and they also have that money tax-free. Is that right?
Yes, it is. And what is great about having a Roth that passes over to your beneficiaries is they're not required to start taking a distribution out of it. Whereas a traditional IRA, if the IRA goes to your children and you've started taking your required minimum distributions after age 70 and a half, then your children have to continue taking that required minimum distribution and can put them into a different tax bracket, or they may have to, whatever money comes out of that IRA is going to be taxable to them. So if all of a sudden, they decide they want to go out and buy a car or invest in something and they need to liquidate that IRA, it's going to be taxable to them as well. So with a Roth, it's really nice is they could let it just sit there, not have to take those distributions, use it when they want, and still pay no tax on it.
Such a good deal.
Yes.
Now, about the 1031, now when those kids received that property as part of the estate, do they, it's obviously taxable to them in the estate when it gets transferred, or is it only when it's sold? How does that work?
Basically, with an estate, everything gets valued as of the date of death, and the estate is taxed based. The estate taxes are a whole different world, but it's based on the total value of the estate. So, if right now our exclusion for is just under $5.5 million for 2015. So if the total value of the estate is under that, then no tax, it passes tax-free to the children, and they get it at whatever the value is at the date of death. So if the thing is worth $4 million, their new basis is $4 million. They turn around and sell it. They get the $4 million. They pay no tax. So it's a way to, get that money, out. Whereas if that, my client were to sell that property at $4 million right the day before he died, and his basis in it is about, I think, $100,000, he would have to pay, capital gains on $3.9 million. And the kids would not have $4 million to, go out and do with what they want.
Wow.
Well, the importance of tax planning.
Yeah,
Yes.
I know.
Yeah.
Well, estate planning too. I mean, that maybe that's something else. We'll have you come back maybe and talk about. We can talk about estate planning because that's
Yeah, and
sure.
And that's a huge issue, just even with, whether you're a single person, you're a family, business owners especially, to have that succession plan in place. I spend a lot of time with that with my clients. How do you want to get out of this business, and what are your plans? Because you want to make sure that your wishes are carried out and carried forward. And if you're running a business, you want to make sure your employees can get paid. If you're the only one with the signature on the bank account and there's no power of attorneys, now what? So you want to make sure that things are covered, and beneficiaries are assigned that you want to, especially sometimes in cases of divorce. Those are little details that get overlooked. And, it's not too happy when, the current wife finds out the ex-wife was a beneficiary on a life insurance or an IRA or what have you.
Ooh, yeah. You better hope you're dead when that happens.
Yeah, that's right. If not, they'll pull you back.
Oh my gosh. That's funny. Okay, John, can you scroll down a little bit and see what else we got there? Because I'm sure we got other stuff.
Well, we have 18 slides, but
Yeah, we probably...
Yeah, and if your listeners have questions that come up, they're more than welcome to email me, or if they contact you, I'd be more than happy to find them an answer. Taxes, it's one of those things that it's so unique to each individual. I don't think I've prepared two returns that are ever the same. There's always a little something different.
Let's see. So you had mentioned, I think, Kim, when we were talking before, you had mentioned something about the health deduction or for business?
Yep.
Okay.
Basically, again, if you own a business, you want to make sure that the health insurance policy is in the name of the business. Just because of the new Affordable Health Care Act, if a business goes and reimburses employees for their health insurance, it is now considered taxable income and needs to be added to their wages. If you are a small business, maybe with only, a wife or husband on the payroll, there's some options for health savings accounts and or some flexible spending accounts, health reimbursement plans where you can get some additional deductions on that.
Right, and so I start to think about some of those savings plans, and so that's with pre-tax dollars, so that can reduce, right? Some of that can happen too, so that can be that can reduce your income.
Yeah, you can do some flex spending accounts to do some pre-tax, setting aside monies for co-pays or items that aren't covered by your traditional policy.
Right, and as I recall, if you put in too much and you don't spend it all, you lose it, so that's not a good deal. So.
Correct. However,
be careful.
You're right. However, if you are if your spouse is the employer, it really doesn't make a difference because it's still staying within the family.
See, there's another little trick.
Yeah, exactly. So it's, if you're working for, a big company and you estimate wrong, the big company's going to keep it. However, if you're employed by a spouse, it's still staying within the family.
Ah, I see. I'm going to start to call you a magician.
Yeah.
So if you're like a trader and that's your only form of income and you use it as a business, you can have a health savings account, and your spouse can be in the health savings account. If she overpays you, you just keep the money.
Correct.
There you go.
From one pocket to another.
From one pocket to another, and yeah.
You can max that one out.
That's right, and if you use it, great, and if not, that's okay too, so.
Wow.
Yeah.
I love it. So interesting.
Yep.
It is very
Yep,
interesting.
You know, the key is to use the tax code to your advantage is
That's
one of my mottos, you know.
Fantastic.
Very true.
Yeah, that's some good
very
stuff.
True.
All right, let's see. We are way over time. Did you want to have anything else you wanted to talk about, or?
I am good. I think there's, one thing that people can take away is that it's not cut and dry, and don't rely on a box
A computer
or
program.
software, right, to guide you through this, because there is no yes or no to a lot of these questions. There's a lot of it depends. That's probably one of the phrases I use quite a bit, because there's always, okay, it could be this way, it might not be, let's ask another question. And you're just not going to get that, from a box, a software program. You have to have somebody that knows, the question to ask in your situation. And
Oh, yeah, definitely. That's so important. Yeah.
Yeah, and it's an investment. It's an investment in your future. A wrong move can cost you dearly. So it's one of those areas where you do want to, seek out that professional. Where I'm a big fan of going to the professional that knows what they're doing, and they're doing it day in and day out, and it's not a hobby. It's just, you're not going to go to a doctor and say, I'm going to go do my own surgery now. Thanks for the advice, You're going to want to have that person that, does that surgery day in and day out. So,
well, yeah. Well, plus, if you take the wrong thing that you weren't supposed to take, that can go very bad as well.
Yeah, it can, and it can cost. I've seen, I have, maybe one day we could do a horror story, at Halloween time. I can.
Oh, yeah. You're not kidding.
Right.
Yeah.
Anyway, this is Kim's contact information, by the way. We have a bunch of people asking for that, so it's right on this slide right here. So that's super.
Great. So thank you very much for having me on. I really enjoy it. If it doesn't come through, I am definitely a tax code geek, and this is really my passion and calling in life. I enjoy living in this world, and
she does too. It's really scary when you go see her.
Yeah. Yeah. What do you do for
We
fun,
go out to dinner. What do we talk about? Taxes. Kim,
Taxes. Yeah.
how do I do
Yeah.
this? And she'll say, Sherry, you do this. And I'll say, yes, I had no idea I could do that. All right.
Yeah.
So
definitely. It really is. It's about building relationships. It's about education. And that's what I love, about your coaching business. And it is. It's about that education and empowering people to make better decisions and to be successful.
Yeah, it's so important because, you can use every edge that you can get for sure.
Yep,
Yeah,
that's for sure. Because we work, profits don't just fall out of the sky. It takes some work, some planning,
Yeah, and then you got to keep those profits as much as you can.
Yeah, Kim.
And it's all about structure.
Definitely. We know all about that from all our years, Kim, huh?
Yes, definitely.
All our adventures. Oh, that's great. Well, thank you so much, Kim, for coming on, and we'll certainly pass along your information. It's going to go on it'll certainly go on our YouTube channel, and so that was
We'd love to have you on again.
Oh, I think.
Great, I would love to. So thank you very much. Have a good night.
Thank you. Good night, everybody.